Today, we're diving into a critical issue that's shaking up global financial markets: the escalating conflict between Israel and Iran. How does this geopolitical tension impact major U.S. stock indexes like the NASDAQ and NYSE? Will your investments take a hit? Stay tuned as we unpack the economic ripple effects, analyze key sectors, and explore what this means for investors like you. If you find this video helpful, don't forget to like, subscribe, and hit the bell icon for more insights. Let's get started. Before we dive into the markets, let's set the stage with a quick overview of the Israel-Iran conflict. For decades, these two nations have been engaged in a shadow war, marked by proxy conflicts, cyber attacks, and targeted strikes. But recent events have escalated tensions to a new level. On June 13, 2025, Israel launched Operation Rising Lion, targeting Iran's nuclear facilities, missile factories, and key military personnel. Iran retaliated with missile strikes on Israel, raising fears of a broader conflict. This escalation has global implications because the Middle East is a critical hub for energy and trade. Any disruption here sends shockwaves through economies worldwide, including the U.S. stock markets. The NASDAQ, which is tech-heavy, and the NYSE, home to a broader range of industries, are particularly sensitive to these events. So, how exactly do these tensions affect them? Let's break it down. When news of the Israel-Iran conflict broke, markets reacted swiftly. On June 13, 2025, after Israel's strikes on Iran, the Dow Jones Industrial Average, listed on the NYSE, dropped 1.79%, closing at 42,197.79. The S&P 500 fell 1.13% to 5,976.97. And the NASDAQ Composite slid 1.3% to 19,406.83. Why did this happen? Geopolitical uncertainty makes investors nervous. When tensions rise in the Middle East, markets often shift to a risk-off mode, meaning investors sell riskier assets like stocks and move to safer ones like gold or bonds. This was evident as gold prices surged 1.5% to around $3,434 per ounce, and the U.S. dollar index rose 0.5%. The NASDAQ, which includes tech giants like Apple, Nvidia, and Adobe, is particularly vulnerable because tech stocks rely on global stability for supply chains and growth. For example, Nvidia shares fell 2.1%, and Apple lost 1.4% as investors pulled back. The NYSE, which hosts a mix of industries, saw similar declines, especially in financials, which dropped 2.06%, and information technology, down 1.5%. But not all sectors suffered. Energy stocks like Exxon Mobil, up 2.2%, and Diamondback Energy, up 3.7%, rallied as oil prices spiked nearly 7% due to fears of supply disruptions. Defense stocks also soared, with Lockheed Martin, RTX Corporation, and Northrop Grumman each gaining over 3%. This shows how conflicts can create winners and losers in the market. Now, let's explore the main channels through which the Israel-Iran conflict affects the NASDAQ and NYSE. There are three big factors to consider: oil prices, inflation, and investor sentiment. First, oil prices. The Middle East accounts for about a third of global oil supply, and Iran is a major OPEC producer. Any threat to oil infrastructure, like the Strait of Hormuz, could disrupt supply chains. On June 13th, Brent crude jumped to $74.60 per barrel, and West Texas Intermediate hit $73. If oil prices keep rising, it impacts industries like airlines, which saw stocks like Delta Airlines drop 3.8% and United Airlines fall 4.4% due to higher fuel costs. Higher oil prices also affect consumer spending as people pay more for gas and goods, which can hurt retail and tech stocks on the NASDAQ. Second, inflation. Rising oil prices fuel inflation, which is bad news for markets. The Federal Reserve was already expected to keep interest rates steady in June 2025, but higher inflation could delay rate cuts or even prompt tighter policy. This is bearish for growth stocks on the NASDAQ, like tech companies, which thrive in low interest rate environments. For example, Adobe fell 5.3% partly due to inflation fears and concerns about slow AI adoption. Third, investor sentiment. Geopolitical risks create uncertainty, and markets hate uncertainty. Posts on X reflected this, with users like @AlphaBIMO warning that a full-scale Israel-Iran war could tank stocks and crypto while boosting oil and gold. When investors panic, they sell off riskier assets, leading to broad declines across both the NASDAQ and NYSE. The CBOE Volatility Index, or fear gauge, spiked, signaling heightened market anxiety. Let's zoom in on how specific sectors on the NASDAQ and NYSE are affected. Energy sector. As we mentioned, energy stocks benefit from rising oil prices. Companies like Exxon and Occidental Petroleum saw gains, and this trend could continue if tensions persist. However, prolonged disruptions could hurt global demand, creating risks even for energy firms. Defense sector. Defense stocks are a clear winner in conflicts. Lockheed Martin, RTX, and Northrop Grumman rallied over 3% each as investors expect increased demand for military equipment. The NYSE, which lists many of these firms, benefits from this trend. Technology sector. The NASDAQ's tech giants, like Nvidia and Apple, face headwinds. Higher oil prices increase production costs, and supply chain disruptions could hit semiconductor and hardware companies. Plus, tech stocks are sensitive to interest rate expectations, which could rise with inflation. Financials and consumer stocks. On the NYSE, financials like Visa and MasterCard dropped over 4% amid broader market declines and fears of reduced consumer spending. Travel stocks, like Expedia and Marriott, also fell due to concerns about rising fuel costs and reduced international travel. Safe havens. While stocks tanked, safe haven assets like gold and bonds surged. This flight to safety hurts riskier equities on both indexes but highlights how investors reposition during crises. So, what does this mean for the long term? If the Israel-Iran conflict escalates into a full-scale war, markets could face prolonged volatility. A post on X by @AlphaBIMO suggested that stocks and crypto could take a major hit, while oil and gold rally. A worst-case scenario, like the closure of the Strait of Hormuz, could spike oil prices to $100 per barrel, hammering global economies and markets. On the flip side, if diplomacy prevails, say, through U.S. or UN mediation, the markets could stabilize. For example, President Trump urged Iran to make a deal on its nuclear program, and the UN called for de-escalation. A resolution could boost investor confidence and lift the NASDAQ and NYSE. For investors, here are 3 strategies to navigate this. Diversify. Spread your portfolio across sectors like energy and defense, which may benefit, and safe havens like gold. Stay informed. Monitor news on the conflict and Federal Reserve policy, as these will drive market moves. Be patient. Volatility creates opportunities. If you're a long-term investor, consider buying quality stocks during dips. Always consult a financial advisor before making investment decisions, and remember that markets are unpredictable during geopolitical crises. The Israel-Iran conflict is a stark reminder that geopolitics and markets are deeply connected. While the NASDAQ and NYSE face short-term pressure from rising oil prices, inflation fears, and investor panic, certain sectors like energy and defense can thrive. By staying informed and strategic, you can navigate these turbulent times. What do you think? How are you adjusting your portfolio in response to this conflict? Drop your thoughts in the comments below, and let us know what topics you'd like us to cover next. Thanks for watching, and we'll see you in the next one.